All right, let's get started. Thank you all for attending this session. For those of you that don't know me, I'm Brian Haywood. I'm an investment strategy advisor here with BAM. Been with BAM for a little more than 13 years. Started back Labor Day 2006. Traded in our fixed income department for a number of years, ran the desk for a couple more. And then about three and a half years ago, Jared Kaiser, our chief investment officer, asked me to take a little bit larger role with our investment policy committee. So here I am, investment strategy advisor. With me presenting is Jonathan. You want to introduce yourself?
Hi, I'm Jonathan Scheid. I'm vice president of portfolio strategy and education for Loring Ward. So I've been with Loring Ward since June of last year, but it's my second time here. So I was previously with the firm from '97 as I was an intern back then, working with Mayor Statman. I was a research assistant, and I was with the firm until 2006. I went to another TAMP and helped that firm for a while, and then Alex Potts recruited me back and told me that it was going to be nothing but fun, and it has been. So, actually it's been, to be honest with you, it has been a ton of fun because we get to work with great advisors like you and the interesting cases that you bring to us. And so one of those solutions is that we've worked with to get to the Loring Ward side. So this is all new to the Loring Ward side of the business, what we're doing on the fixed income. So you're on the Loring Ward side of the business. If you came to this conference with that background, there's a lot of good things here to pay attention to.
Thanks. Before we get into the presentation, just remind you, if you need CE credit to see our friends in the back there, make sure you get your badge scanned. With that said, why don't we get into our fixed income solution. So in this particular presentation, and for those of you that are familiar with our fixed income, this might be a little bit of a refresher here, but for those of you from the Loring Ward side of the table, this is brand new. But we're going to talk about our department, our business model, our philosophy, and then the implementation of the fixed income model here at BAM. So, brief overview of our department. We've got 7 full-time fixed income advisors. You'll get to meet all of them here. They should be here tonight as well as throughout the conference. Really great people. So they do nothing but fixed income trading all day, every day. So they're not product generalists. They don't do a little bit of equities, a little bit of fixed income. Nope, they're strictly fixed income. So they're in the trenches day in and day out. We have 2 trading specialists, so even though we are the fixed income desk for our Buckingham and BAM clients, actually all of the trades come through our desk, so we do have 2 trading specialists that handle mutual fund and equities. And then, although they're not technically part of our department, we work with investment analysis very closely, so we have 5 portfolio analysts on that crew, and they help us do fixed income analyses as well as markup analyses, and Jonathan will cover those a little bit later in the presentation. In terms of assets under advisement, and these numbers are a little old, these are as of the end of last year. We had about $12 billion in fixed income. You can see roughly 2/3 of that was individual securities and 1/3 was bond funds. We prefer to use individual securities as much as possible, but obviously you realize not everyone is of the asset level where it makes sense to use individual securities. So for those smaller clients, we will still use funds. And last but not least, we traded about $3 billion last year in 2018. We're on pace to, I think, about 3.2. Kevin, if my numbers are off on that, please correct me. But last time I checked, we're on pace for about 3.2 billion in trades if the run rate goes as expected. Now, in terms of the types of securities we buy, you can see the vast majority are brokered CDs, as well as taxable and tax-exempt municipal securities. And then obviously we've got a smattering of agencies, TIPS, and some other securities that are kind of lumped in there. Those are securities we haven't sold, but a client may have transferred in, and we don't want to sell it for tax reasons or whatnot. A lot of people wonder why we have such a high allocation of brokered CDs. A lot of people think, well, I can go to my local bank and get that. Why are you guys buying that for me? There's got to be something better out there. And the reason we buy brokered CDs is actually they trade on a pretty wide spread to treasuries. So you're averaging anywhere from 30 to sometimes north of 60 basis points over treasuries with obviously similar credit quality, as long as you're staying within FDIC insurance guidelines. And also, just as a caveat, we can get pretty similar rates that we can get in the high quality corporate market, in the brokered CD market. Also, one of the reasons we can buy brokered CDs is because we're buying for the individual clients. We get that pass-through FDIC insurance coverage. So if I'm buying for my account, I get $250. We're buying for Jonathan's account, he gets $250. They don't lump them together. Unlike if you're trying to do that in a fund structure, you don't get that pass-through coverage for each individual investor. You get it just at the fund level. So, if you're running a giant mutual fund, you're only getting $250 per bank, and it's really hard to exploit this market because it's just not that big. And then obviously we use tax-exempt munis quite extensively for clients in high tax brackets for obvious reasons there. Any questions before I move on? Yeah. So it's basically just like any other municipal security. It's a college or a local municipality borrowing, but for whatever reason they structured the deal to be fully taxable as opposed to tax exempt. So there's really no difference aside from the taxation of the interest. Yeah, this was big. A lot of them came out around the Babs time, Build America bonds. I want to say like 09, 10, I think is when that came out. So there was a incentive for municipalities to issue debt for infrastructure projects, but it had to be issued in federally taxable form. So yeah, it's not a big market, but it is a substantial market. Yeah, obviously the tax exempt side of the municipal market dwarfs the taxable, but you can still get some good deals in the taxable municipal market. Yeah. All right. Now I'm going to shift over to our business model, and I'm going to spend a decent amount of time on this because this is really where we separate ourselves from traditional broker-dealer model, which for the most part is what most prospective clients or existing clients, what they're used to when it comes to fixed income. They're used to the broker-dealer model. And with the broker-dealer model, the way they operate is a broker-dealer, to make money, they'll buy bonds into their inventory from the street, they'll mark those bonds up, and then they'll sell those bonds to their clients, to their broker network. Now, the disadvantages of that are the bonds are just sold out of inventory. So when a broker's got a client and they've got money to put to work, they're typically just going to their own firm's inventory and selecting a bond out of that inventory. So they're not going out to the street to see what else is available for the client, so that they're honing in on a small subset of bonds. And then on top of that, those bonds typically have a pretty significant markup. When we say significant, it's anywhere from about 1% to 3%. So on a $100,000 bond, that's $1,000 to $3,000 in commission. And that's typically doesn't have to be disclosed to clients. I know there is an SEC mandate to disclose it, but there are easy ways to get around having to disclose that. Holding it an extra day, some things like that, where a broker can avoid actually having to disclose that to a client. So typically they only see a $25 to $50 fee. Well, they're really paying $1,000 to $3,000 for the most part, and that translates to a much lower yield. The broker-dealer model is typically just transactional. I can't tell you how many portfolios we've analyzed over the years, and I asked clients, just talk me through your broker strategy when it came to building your fixed income solution. And for the most part, I get a deer in headlights look, like, I don't know. And pretty much because there basically was no strategy. It was client had money, there was a bond with a nice markup in it, it was suitable, boom, it's in the client's portfolio. I mean, I hate to say it, but that's how it works. I used to work on this side of the ledger. It's not bad people, it's just a bad model. As you can see, this model here is rife with the conflicts of interest. Obviously, there's a winner and loser on each side of the trade. If I'm a broker, I want to get the best commission. I want to make the most money. But unfortunately, that commission comes at the cost of a lower yield to that particular client, and vice versa. Now, contrast that with our model. Well, first, we take the conflict of interest out of the equation. So all of our advisors, all of our staff is paid on salary. We're not paid on commission. So we're not incentivized to sell bonds to clients. That's not what we do. The way we like to position ourselves is we are your client's personal bond buyer out there in the market. We're sitting on the same side of the table as your client in the transaction. We're trying to get the best bond possible at the best possible price. And the way we do that is, first, we are not allowed to hold an inventory. Being an RIA, we are not legally allowed to have one. So that means we don't have a subset of bonds or a pot of bonds that we're incentivized to go move. So we're always looking out on the street to find the best possible bond at the best possible price. Now, we have to source bonds from somewhere, so we do have a network of broker-dealers that we do business with. It's a network of about 20 to 25 broker-dealers. And what we do is, to ensure that we're getting the best possible execution, is we put each trade we do, we put all those broker-dealers into competition with each other. So what that does is that drives the cost down significantly. So as opposed to 1 to 3% markup, the average markup we experience is about 1/10 to 2/10%. So on that same $100,000 piece, that's $100 to $200 as opposed to $1,000 to $3,000. And that cost savings is passed along to your client in the form of a higher yield. We don't keep that. That goes to that particular executing broker-dealer to pay for their time and services. And just to underline that, we actually have no ability to mark up the bond, even if we wanted to. We never take possession of a client's bond. So if I buy a bond from Morgan Stanley for a particular client, it goes directly from Morgan Stanley to Schwab, TD Ameritrade, Fidelity, wherever your client would happen to custody their assets. We never take delivery of that security, so we wouldn't even have the option of trying to mark that security up. What I really like about this model, what really a lot of clients say they love about it is, as I mentioned, the totally unbiased advice. We're not incentivized to do anything. So if the right move for your particular client is to do nothing, we're going to tell that client, don't do anything. If the right move is a treasury, we're going to buy a treasury. I can tell you that the portfolios we analyze rarely have treasuries. They almost never have brokered CDs. And the reason for that is there's typically not a whole lot of money in those types of products. It's typically what you find in there are munis, structured products, mortgage-backed securities, things with high markups in them. Typically not treasuries, because the only way to make a lot on treasuries is to be trading huge blocks of treasuries. And then last but certainly not least, we're held to a fiduciary standard. While we would do this anyway, because that's the way we structure our company, from a legal perspective, we have to do what's in the client's best interest. Unlike the broker-dealer model is just held to a suitability standard, which is a dubious standard, to say the least. I can tell you, working on the broker-dealer side for a number of years, I saw some things that never really made me feel all that great in terms of things some of my colleagues did, but it was suitable. I mean, you really have to do something pretty egregious to run afoul of that. So in short, I really feel like that's our value add, is being able to put ourselves on the same side of the ledger as the client and being able to select bonds for them, be their personal bond buyer out there as opposed to trying to sell them something. Now let's get into the philosophy. How do we think about the fixed income markets and how do we deliver this solution? So when it comes to fixed income, there's three main types of risk. There's interest rate risk or term risk, credit risk, and then reinvestment risk. So interest rate risk or term risk is the risk that you buy a longer term bond and yields go up and the value of that bond drops significantly, or vice versa. It adds more volatility to the portfolio. Credit risk, that one's pretty self-explanatory. That's a risk you buy a bond from a particular company or a particular municipality and they default. They can't pay all the interest and principal back. And last, we have reinvestment risk. So that's a risk when a bond comes due that you'll have to reinvest those proceeds at potentially a lower interest rate. Now, credit risk, that's pretty easy to mitigate. Obviously, you can just buy higher quality instruments. Interest rate risk and reinvestment risk, though, are harder to hedge. And the reason for that is they shift with each other. They're at odds with each other. If you totally hedge interest rate risk by buying nothing but short-term bonds, you're exposing yourself to a ton of reinvestment risk, and vice versa. If you totally hedge reinvestment risk by buying long-term bonds, obviously you're introducing a lot of interest rate risk. So I'll show you how we try and balance those two risks out in terms of how we construct our fixed income portfolios. Now, let's take a little closer dive into the interest rate or term risk and credit risk by looking at some of the premiums out there in the market. So I've compared all of these particular premiums. So the first, we have the market premium, and I'm going to compare them versus the market premium. So obviously we're all pretty familiar with the market premium, how much Equities have outperformed short-term fixed income. Not surprisingly, it's a pretty large premium, 8.3% going back 1927 through 2018. That should be pretty much expected. Obviously, there's a lot more volatility in stocks. They crash, so you're going to demand a pretty large premium for owning those types of securities. Now, when it comes to term risk, we broke that out into 2 time periods. So we're looking at intermediate term, which is basically 5-year treasuries minus T-bills. And you can see the average return has been about 1.8% per year. Now, when you go out a little farther, looking at long-term, so think of that long-term bonds minus 5-year treasuries, the return slips quite dramatically. The return's only been about 0.7% per year. So you get the vast majority of the return within the fixed income curves in the first 10 years. We looked at this, I think, a year or 2 ago, and if I remember my numbers correctly, when it comes to the treasury market, you've gotten on average about 85% of all the yield in the treasury curve within the first 10 years. With the municipal curve, it's not quite as dramatic, but it's still about 75%. So we don't really pursue this long end of the curve, and I'll show you a little bit more why we don't do that. When it comes to credit, broken it down to investment grade and high yield. You can see investment grade haven't gotten all that much additional return, only about 70 basis points per year. But if you look at high yield, that looks a little enticing, 3.2. When you think about the various premiums here in the fixed income markets, that's the biggest one. So a lot of people ask us, well, should we pursue high yield credit? Well, I'll show you in a little bit why we should or shouldn't. So while those premiums are fine to look at on their own, it's nice to be able to have a little bit more apples to apples comparison by looking at the risk adjusted return, or the Sharpe ratio of these particular premiums. That really gives you an idea of how much return you're getting per unit of risk. So when it comes to interest rate risk, I broke out the intermediate term premium and long-term premium. I looked at the Sharpe ratio in comparison to the market. So you can see the market premium has had about a 0.41 Sharpe ratio. So what that means is you've gotten about 41 basis points of return per 1% risk, or 1 unit of risk. You can see in terms of the intermediate term premium, pretty similar Sharpe ratio. You've gotten about the same risk-adjusted return that you've gotten in the market. But when you look at the long-term premium, the Sharpe ratio decreases significantly. And the reason for that is obviously you're adding a significant amount of volatility when you go out further on the yield curve. So because of that, we don't target long-term bonds. We basically target the intermediate portion of the curve, so basically 10 years and shorter. And much like our friends at DFA, we use a variable maturity approach. So when yield curves are steep, we'll be close to that 10-year end of the curve. And when yield curves are shallow, like they are right now, where you're picking up very little to go out for each additional year, we're going to be basically 1 to 5. So, and then all areas in between, depending on the shape of the curve at the time. Now let's take a little bit closer look at the credit premium. So ran the Sharpe ratio on this, and you can see here investment grade credit premium, Sharpe ratio is only about 0.13. So not only did we not pick up much in terms of absolute return, but also when you look at the added volatility of owning investment grade corporate bonds, it hasn't really added up from a risk adjusted return, only about 0.13, which falls well short of the market premium. And then when you look at the high yield credit premium, if you remember on an absolute return, that was the highest one, 3.2%. That looked pretty enticing. Why don't we go chase that one? That's the largest premium out there. Well, when you consider the additional amount of risk, the Sharpe ratio falls quite dramatically. You're adding a significant amount of volatility. Just to give you an idea, the high yield credit premium had a standard deviation of about 16.2%. Anybody want to take a guess what the stock market, the standard deviation is roughly of the stock market? It's about 20. Yeah, especially if you look at our kind of small and value tilted portfolios, it's about 20. So the high yield credit premium in terms of volatility had pretty similar volatility to the market premium, but was obviously significantly less in terms of gross return. It was only 3.2 versus 8.3 for the market. Also, it's important to note, when you look at either investment grade or high yield corporate bonds, the correlation to equities is significant. So adding that risk, not only does it come with more volatility, but it comes with additional correlation to the equity markets, which means your fixed income is becoming less effective at diversifying your portfolio. It's starting to act more like fixed income. So when the equity markets are doing well, great, these are likely going to be doing well also. But the bigger thing is when equity markets crash, these tend to go down as well. And that's not obviously what you want to see from your fixed income portfolio. If you think back to 2008, what high yield bonds did, I can't tell you how many prospective clients came to us and said, I've got a 60-40 portfolio, I can't understand why my fixed income is down so much. And you looked under the hood, what was high yield bonds? Well, when risk is not in favor, high yield bonds, the bid for them is not good. And so they decrease in value quite significantly. So because of that, when it comes to targeting credit, we want to avoid taking any credit risk as much as we can. Obviously, on the taxable side, we're buying government guaranteed or quasi-government guaranteed securities. And then on the municipal side, we're buying AA, AAA rated securities in low default sectors. So we're mitigating risk as much as possible. We can't totally eliminate it on the municipal side, but we can mitigate it quite a bit. And then last but certainly not least, reinvestment risk. As I mentioned, reinvestment risk and interest rate risk are at odds with each other. You've got to balance them out because you can't totally hedge both. So what we do is we create a ladder. And what all the ladder is, it's an equal amount of par value coming due each year. So in this case, just created a simple, client had $500,000, so create a simple 1 to 5 year ladder. We've got $100,000 coming due each year. And so what the ladder allows us to do is balance those two risks. If interest rates go down, well, these longer term bonds are going to go up in value, and they'll kind of counteract the fact that the bond that is rolling off has to be reinvested at those lower yields. And vice versa. If interest rates go up, yes, these longer term rungs will go down in value, but the bond that's rolling off will be able to reinvest that at a higher rate. And what it does over time is it smooths out the overall yield or overall return of your portfolio. You're not going to get whipsawed like you would if you had a really short-term portfolio or a really long-term portfolio. So basically, that is why we build fixed income ladders the way we do.
So say a client had an additional $100,000 they wanted to introduce here. How do you work that in?
Great question. So it depends on what the curve looked like at the time. If the curve was steep and it made sense to go out to a 6th year, that would be the way we would go. If the curve was still shallow, we'd probably try and divide it up amongst these rungs to give us the best yield. It's not going to be perfect because we wouldn't want to buy 20 lots across each rung to totally be even it out, because a 20 piece is going to be less liquid. But maybe we would, we'd go 50,000 here, 50,000 here. It really just depends on what the curve looked like at the time we were reinvesting that money, as well as it would depend on what type of security we'd be going in. So in general, in terms of philosophy, we want to minimize credit risk. We want to minimize interest rate risk by purchasing short to intermediate term ladders. The biggest thing, and really what differentiates us from a lot of other separately managed accounts out there, is we concentrate on the best after-tax yield. So unlike a lot of SMAs out there that, you pick a strategy, you pick their short national muni strategy or their intermediate CAL strategy or whatever their particular strategy you're focusing on, and they only do that. When it comes to our ladders, we have the ability to shift between taxable and tax-exempt bonds depending on that particular client's federal and state tax rate. So we have the ability to custom tailor each fixed income ladder to each individual client, as opposed to a client gets a kind of cookie cutter one-size-fits-all approach. We customize it to each particular client to try and get the best after-tax yield. And so over time, likely most of your clients will probably have a mix of both taxable and tax-exempt bonds, because even for clients in the absolute top tax bracket, there was a time earlier this year where we were buying taxable bonds. And there's been times where even clients in lower tax brackets, it made more sense to buy tax-exempt bonds. So we're always looking at those curves and how they're trading versus each other to ensure we're getting the best possible bond at the best possible price. And then last but certainly not least, we do ongoing monitoring of all of our portfolios. So this not only includes credit monitoring, so we'll alert you to any changes in credit quality in any of your client portfolios, but we also look at 18 other material events behind the scenes. I won't bore you with all the details of those, but if one of those events warrants a change to the client's portfolio, we will alert you to that. And then every Friday, we send out a redemption report, so that looks at the coming week, and we'll alert you if any of your clients have a bond maturing or being called for the upcoming week, so you can plan accordingly. If a client needs a distribution, or if that money maybe needs to go back in the equity markets, or wherever that needs to go, you're going to be alerted so it's not sitting in cash for any extended period of time. All right. Now, in terms of why we like to use individual securities as opposed to bond funds, and it's not that we don't like bond funds. We certainly think bond funds are a positive thing, and if you're investing in the fixed income markets, bond funds are fine to use. We just think it's a better solution if you have the asset level to use individual securities. And the reason for that is just the way the markets trade. So in the equity markets, the vast majority of risk is company-specific risk. How does Coke do versus Pepsi? How does Google do versus Facebook? So on and so forth. Because of that, because most of the risk is there in the individual security, at the individual security level, you need a lot of diversification. Because otherwise you're going to have very concentrated risk, and you could end up picking the loser, and you have a much lower return than the overall market. So to sample the market, you need a number of securities. You need to be highly diversified. On the fixed income side, and there's one big caveat here, this is if you are keeping the credit quality high. As long as you're keeping the credit quality high, fixed income tends to be a lot more commodity-like. So the vast majority, the biggest driver of return is going to be overall interest rates, which you can't control, and you can't diversify away. I don't care if I own 10,000 securities or 10, I'm still going to be subject to the whims of the overall market in terms of interest rates. But what that means is I can sample the market with a relatively small amount of securities because of that fact. Again, that's as long as we're keeping the credit quality high. And so what buying the individual securities versus the bond funds has, the advantages are potentially lower costs. You know, if we're in a bond fund, there is an expense ratio. Even though it might be low, there is an expense ratio. If we can use individual securities and do that at a lower cost, that's better returns for us. We have greater transparency. You can log on, your client can log into their website, Schwab, Fidelity, TD Ameritrade, can see all their bonds anytime they want, as opposed to a bond fund. There's a little bit of mystery there. You only get one look a month, and it's usually dated. The customization, talked about that a little bit ago. We can custom tailor each portfolio to each individual client's wants and needs, as opposed to a bond fund where the bond manager, you're ceding that control to them. We know the payment schedule, so we know when we're going to have liquidity, we know when we're going to have interest payments, all those various things. And then last but certainly not least, we can do tax loss harvesting at the individual level. So when rates go up again, and I don't know if this is wood, but I'm going to knock on it, hopefully at some point in the future we will see higher interest rates. And when we do, obviously these bonds are going to, a healthy portion of the client's portfolio is probably going to be at a loss. Well, if we're using the individual securities, we can tax loss harvest at the individual security level, as opposed to a bond fund. You have to sell out of the entire position, stay out of it for 31 days, use a proxy fund, and who knows, depending on where rates go, you could get trapped in that proxy fund, which is not ideal. You'd prefer to obviously be in your number one preferred fund.
All right.
Yeah.
In those situations where interest rates change, are you doing a break-even analysis to see if it makes sense to sell and not take the principal of maturity with the increased income?
Yeah, so for the most part, given that you're going to have to pay the spread, even though it's not great, For the most part, a lot of times it doesn't necessarily make sense to tax loss harvest. If you have a small loss, you've got to have a decent loss for it to make sense to harvest that. But it does give us an interesting opportunity to look at, if client is in a lower tax bracket and owns munis, that could be an opportunity to potentially take a loss and switch into taxable bonds and come out ahead. So we do the math of, okay, here's the tax gain we're gonna have. When I say tax gain, the loss, and then how much that's gonna save us in taxes versus the transaction costs of executing the sell and then buying back. So we are analyzing that to see if it does make sense. Yep. All right. In terms of some of the services, I'm just gonna go through this pretty quickly. In terms of the initial portfolio build out, we can consult on any existing positions, so don't feel like if you've got a client that does have existing positions or a prospective client and they come over, we don't just blow everything out. We'll look at the existing positions and make recommendations on whether to sell or whether to hold. In a lot of cases, we do build around existing positions. We can generate proposals for planned purchases, as well as obviously we execute all the purchases. In terms of portfolio maintenance, talked about this a lot already in terms of our monitoring, but a major thing is we do ongoing FDIC insurance monitoring. Obviously, that's a real hero or zero strategy. If we're over FDIC insurance by 100,000, that bank blows up, that 100,000 is gone. There's no recovery there. So we want to ensure that all of our portfolios are within FDIC insurance limits at all times. So we built a proprietary system that looks across all of our portfolios to ensure that we are in compliance. And if we are not, we get an alert. For example, last Thursday we got an alert because client originally had a joint account. So we had 500,000 in coverage. Well, the husband passed away. All of a sudden that account becomes an individual account. Well, now we're over. We got a notification the next day saying that that portfolio was out of tolerance. So we went in there and we had to sell some of those securities to get ourselves back within FDIC insurance limits. So we're monitoring that on a daily basis to ensure that we are in compliance with that. With that said, I'm going to turn it over to my colleague Jonathan to talk about the implementation.
Awesome. All right. Thank you, Brian. Great job walking through our philosophy and the rationale behind how the portfolios are constructed and built. So what I wanted to talk about here was a couple things. Number one, our merger, the Loring Ward, BAM, Buckingham merger, presented this opportunity for us to evaluate this strategy and bring individually managed bond portfolios to the Loring Ward advisory community. So we viewed that very favorably because it was, believe it or not, one of the things that we heard a lot of feedback from our advisors and different prospective advisors that were kicking the tires. There's, obviously BAM and Loring Ward are the two largest evidence-based TAMPs that are out there, and so we'd always have those as kind of trade-offs. Okay, you guys do this, we do that. Now, combined, we get to do both, right? So in that process, we didn't want to go and just roll out the solution as is. We from the Loring Ward perspective, we said we wanted to go and understand why we would want to do the portfolios this way, and number two, is this the best solution that we can actually bring to our clients that want individually managed bond positions. And so what we did was embark on a little due diligence project where we evaluated 8 separate account money managers that are available through the major custodians. So we looked at the big names, BlackRock, Nuveen, Eaton Vance, and even some of the more specialized players. We had all 3 of those in our office, giving us presentations and trying to understand what they're doing. And then we compared and contrasted that versus what the BAM solution looked like. And there was a couple areas that the BAM solution really stood out. Number one, it was pretty cost competitive from what they were able to show us. And then number two, and we think this is by far and away a huge advantage, is that it was customizable. And we're going to walk through what that means in a little more detail, but all the other separately managed accounts providers that we came across, you have to follow what their requirements are, or their predefined objectives. So, you went and found manager A, and you hired them for a intermediate term municipal bond ladder. that's all that they would look at. You know, you went and hired a government bond ladder. That's all that they would look at. Now, remember that wheel, the little pie chart that Brian showed earlier of the different securities that were out there that they're using in the portfolios, right? Some of the two biggest allocations were munis and CDs. And so what the reason that you're seeing both of those is because they're doing an analysis that's based on the individual level. That's something that none of the managers that we were talking to would do, and they would do at a reasonable price. So I think that was what gave us a lot of comfort in rolling the solution out. And so for the Loring Ward community, like that, those are some of the reasons that, you know, we wanted to get behind this strategy and roll it out to our advisors. And for the BAM advisors that might have been using this, you know, take that as like, hey, you've got a great solution that you're already using. So some of the information that I'm going to share is going to be very Loring Ward specific, just because the nature of our business is a little different, the way that we partner with our advisors, but we can take any questions along the way or handle those afterwards if we need some more time. But the way that it's really packaged is focused on maximizing that after-tax yield. So that one advantage that we saw versus all the other managers really stands out. Brian and his team focus on 3 areas in the marketplace. They'll look at municipals, AAA or AA rated, treasuries, tips, or traded CDs. And that's about it, right? All of those are very high quality, right? 3 of them are government guaranteed, or what's the right term to say? Quasi-guaranteed by the government, thank you. And then the others are very high rated, right? So default rates on AAA and AA are very low. You start going a little lower and you see those default rates move up. So the mix of the bonds is always going to be determined by what Brian and his team find is the most advantageous given your client's information. And that information is basically their tax rates and the type of account. The ladder length, as you mentioned earlier, is going to be variable. And so just to put some numbers to it so you get the idea of the range, it's going to go from as short as 1 to 5 years and as long as 1 to 10 years. And then, you know, there's a question on, hey, here's 10,000, or even if there's a need for 10,000, that gives them the opportunity to change that based on where yield curves were, or where they are. And I'll just share, when we started this, we were seeing most of the length, when we started this earlier this year, before the Fed made their changes, and actually the market reacted to potential changes, we were seeing ladders in the length of 1 to 6, very common, and now we're seeing them on the shortest end of that 1 to 5 range. We do have an account minimum on the Loring Ward side of 500,000. Is that the same on the same on the BAM side? So this is a strategy for clients with some assets, right? So it's not for everybody, and it's not for your smaller accounts. But that account minimum is the amount that's going to be invested in fixed income. So it's not just a $500,000 account. It needs to be $500,000 allocated to fixed income. Now you can hit that minimum by using multiple accounts, so that's not by registration. You can take a qualified and a non-qualified account to meet that 500,000, and that's not an issue. And then we do ongoing account management. There are some fees to be aware of, right? So since Brian and his team are trading, I'm going to get feedback, I'll stay away, sorry. Since they're trading on third-party platforms, the custodians aren't getting a piece of the action, right? So if you go to Schwab, and Brian was talking about the markups that you typically see. Schwab says that they actually have traders that will build you bond ladder portfolios. Now they don't look like the ladders that we put here. They're a lot lumpier, even though they call them ladders. But they get paid there, right? Because they're charging markups. Now they don't get paid when Brian's trading outside. With his network, trying to get the best price. So they want to get paid once those bonds come back, so they charge a simple custodian a trade fee there for those funds coming over. And then there is a fee schedule associated with the bond management process. And this is that other area that I was mentioning earlier when we did our in-depth analysis of the SMA marketplace. The cheapest SMA manager we found out there was at 10 basis points, and that gave you a very plain vanilla bond ladder. You pick the length, and no active management. We'll just set it up, and then out we go. We'll watch to see if something gets liquidated early or matures, and then we'll go in and reinvest. And then it went up from there. And so given that we've got this flexibility that we're customizing and really focused on maximizing that after-tax yield, we thought it would be very reasonable to charge 15 basis points. And it's very close to where we're seeing, or it's actually under a number of the funds that advisors have used in the past from the alternative standpoint. So the way that we're positioning this and the way that we think about it is, look, you know, you're using a mutual fund charges an internal expense ratio. This is the equivalent of that. It's just on the outside, in the back.
So on your fee schedule, are you doing that separate? So let's say you have a client that has a $2 million portfolio to determine their asset allocation, 50 equities, 50 fixed income. So you got $1 million in equities, $1 million in fixed income. Are you doing a separate fee schedule on the equities and then charging 15 dips on the fixed income? Or are you just doing a global fee on the two?
So we're charging it as a separate outside fee on the fixed income account only. So on the fixed income portion, that's only there.
Separate fee schedule that the $1 million would be managed under and then 15 dips on the $1 million fixed income.
Yes, yeah. And actually, so that actually is a good segue into how we do set it up. We are using a separate account framework to implement this. So, you know, there's a couple ways that you could implement that. You could say, hey, here's half of my account that's allocated to equity, and here's the other half. So how do you handle the billing? Well, you know, those things move around. What we've decided is to keep them separate, and that allows for the fixed income trade to know exactly how much money they have to manage, and then it does make billing a lot more straightforward because we know what the assets are at all times in that. You got a question?
The fee schedule and what you're talking about now, is this for Loring Ward? Is BAM operating differently? Because what you're describing now is not my experience as BAM.
Yeah, so this is Loring Ward centric.
Okay.
Yeah, so this is just for advisors under the Loring Ward umbrella.
So I guess that's a question, because you know, a lot of BAM firms charge just one fee,
Yeah.
whether it's a balanced account, regardless how much is in fixed or whatever, unless you just got like a huge client doing a pure fixed income only portfolio. Given that you now got one arm doing it this way and a whole group of advisors doing it a completely different other way, what's the thought of going forward, how that's going to be handled?
That's a little above my pay grade. So I will say, I mean, we're not even a year out from when we got together, and we just started offering this to Loring Ward advisors in August of this year. So we haven't determined going forward what the long-term solution is going to be as far as fees go.
So you could have, you know, a client, it's a BAM client, and then
Yeah.
this one's a Loring Ward client,
Yeah.
they're getting the fee differently.
Yeah.
Yeah, but you also have to recognize the service. The service that the BAM advisors receive is different than the service that the Loring Ward advisors receive. And so, you know, we think everything is fair from a market cost standpoint. And so that's a conversation you could also have with your regional director. And so we would encourage you to speak with them about the differences between the models of doing business, because you know, the Loring Ward strategy is very, very full service, right? So we have a team doing your trades. It's very similar to BAM 3.0, if you're familiar with that. And if not, the Loring Ward side we do your trading, we do your reporting, we do your billing. We give you the technology to have access to performance reports, everything, and a whole slew of marketing and other tools. And so, you know, it's just a different structure from how our business are. But I think our regional directors are a really good place for you to go and have that conversation, because there's multiple ways that advisors are able to do business with us. We don't see that changing anytime soon. And one good example is our platforms, right? Our platforms are different. You know, the Loring Ward side is on an InvestNet-based platform, and the BAM Buckingham side is on an Orion-based platform. We've made a commitment to both of those companies for at least the next 3 years to be multi-platform, so our advisors didn't have to be forced into changing the way that they're doing business with us at this point in time. That's a great question. So the question is, now that we're implementing these as separate accounts, how do we move money between the two accounts? And that's actually something that our traders do on our behalf. I say we become quasi-overlay managers. And so in that process, when money's needed, when there's deposits that come in, or rebalances just occur when we get that signal, we have a trader that goes through and will say, okay, I need to move X amount of dollars into the fixed income, or I need to take X amount of dollars out of fixed income. That request goes over to the trading group, and then they'll implement those changes.
Let's say like the TD account, will individual bonds show up, or will it be a separate account that shows up?
You'll see the individual positions, yeah, it'll be a separate account, and you'll see, just like any other account, the actual security.
And it's going to depend on the report that you look at, because some reports don't have individual securities. In that case, you're just going to see the account, and these are going to be titled the same way. So in like our default quarterly reports, you're not going to see the difference between the fact that there's two accounts. On the custodian statements, custodial statements, you will see differences on the statements that we send out and prepare. Those are usually a level up at the registration or even at the reporting group level. You're not going to see any of those operational implementations.
Bonds usually, like, let's say you do the 500,000, how many bonds are there for the trading costs?
Yeah, we set a limit, and we don't want any more than 10% in any one particular credit, unless it would be pre-refunded or government guaranteed, like a CD or something like that. So we don't want any more than 10%, and really, depending on the size of the account, it ends up usually being more like 3 to 5% in any one particular. And then we also have we don't want any more than 35% in any one particular state. So we do have some roadblocks there in terms of what size.
Does it go through Loring Ward, or does it go through them?
It goes through Loring Ward. Yeah, and so we actually put together, because Loring Ward doesn't have discretion on our accounts, and so we had to create a sub-advisor agreement. So in addition to a tri-party or a bi-party agreement that you might be using with your clients, that we have another agreement that you're going to need for the fixed income account, and that's the sub-advisory. There's other paperwork there, but your relationship manager can help you work through what are the requirements. But I want to highlight a couple points here and then talk about market materials, and we'll take any other questions. So we will do the monitoring of drift across the accounts. Fees, we have a preference of pulling the fees out of the non-fixed income account. We think it's just smoother and easier to track. So I mentioned earlier that the QPRs, that they don't have any issues with individual positions. They just work their way through. And then if you are an RIA and you're looking for sample ADV language because you want to start using this service, we have all the documentation that you'd want to consider and where to put the different parts. And finally, you're not alone just to go and make proposals. There's a lot of tools that are available to you. The first three here require you to have a client have existing fixed income holdings. So let's say a prospect comes to you with a bunch of individual bonds. These reports are wonderful because one's going to do a comparison of the ways that we could improve on how that portfolio is allocated. That is the fixed income analysis report. The other one, if the client had munis, and let's say they're coming over from a wirehouse where they said, hey, I was getting my bond trading for free, well, the team can go and try to figure out, using some publicly available information, if they have the trade date and the trade price, they can go and figure out what the markup was likely on those bonds. And it is kind of eye-popping sometimes because they thought they were getting it for quote-unquote free. And then finally, the traders will go through, and if they don't need to sell a bond, they're not going to want to, because every time you trade a security, there is a cost associated with that. And so they'll tell you what they feel you should sell and what you should hold. So they can get you, and they'll work through these steps depending on how confident you are with the prospect and where you are in that process. And then finally, any client, and you guys can run these reports at any time. If you want to just get an understanding, you can send a request in through a relationship manager or if you're on the BAM side, to the fixed income desk, and request a client proposal. Just tell us the federal and state tax rates that the clients are being charged, the amount that they have to invest, and the type of account that it is. With that, we'll open it up for any other questions.
Yeah, so the way a brokered CD works, it works like any other fixed income security. So there's a secondary market. There's no stated interest penalty, so you're not giving up 3, 6, 9 months of interest. It will fluctuate with overall interest rates. So if interest rates go up, value of that CD will go down and vice versa. But yeah, you can sell it. There's an active secondary market for it.
So just to get an idea, so if we had a $500,000 5-year lag, just like we're talking about, it's all in CDs right now, what would be the gross yield on that, about ballpark?
If I had to ballpark it, I mean, fixed income rates are low. I mean, there's no doubt about it, but it's going to be probably right around 2%. If I had to ballpark it. Yeah.
Outside of reinvestment risk, how are you talking through with clients that are looking at investments in cash that should just be pure? 5-year CD is 2%, money market fund is 2% as well.
Yeah, I mean, obviously it's not a fun conversation with where interest rates are. You know, we're dealing with that all the time. The question is, if it's not going there, where's it going to go? You know, if you're trying to stretch for yield in the fixed income markets, it's just not there. The yield curve is incredibly flat, so it's not like you can go way out and get higher yields there. Also, with everybody searching for yield, I mean, just credit spreads, everything are just so compressed. Everybody's looking for the same thing. So it really becomes a question of, if you want to increase your return, trying to do that in the fixed income space is the absolute worst place to try and do it. We would recommend either increasing your equity allocation, and you don't need to do it, you don't need to increase it a whole lot to increase the return, or look at some of our liquid alternatives. But trying to get additional yield in the fixed income markets, it's just not the place to try and get additional return.
And the other thing to think about is how long the client's going to have their cash allocation, if that's what it is, or how long do they need the access to the money? Because the way that this program is set up is that it's a longer term investment horizon, right? You know, we don't want to go and have you 2 years in say, the client needs all their money now for the home that they wanted to purchase. Like, that's not what this program's for, because you're going to have all those transaction costs to go set it up and to back it out. And so there might be better instruments available for you to use in that process. Over here.
So with spreads so low, what's the difference in just running with the DFA fund we have it running versus DFA?
We look at the yield on the fund, and that's the best we can estimate. So just looking at that, it's going to be pretty close. Now, granted, we're looking at a yield on DFA's funds as of September 30. It's not as of today. But if you factor in the expense ratio, it's going to be in the ballpark of what we're building. If you're looking at like 5-year global versus RCD yields, it's going to be in the same ballpark. It might be about 10 basis points higher. But again, that's as of September 30. It's not looking at September 20 or October 20th.
I'll add, some of this is behavioral, right? So when working with some advisors on the Loring Ward side that were just starting to use this, they were really excited. And even if the rates were comparable, it was just something different that the guy down the street wasn't offering. The guy down the street might be offering an all ETF portfolio solution, whereas now you've got a strategy where you've got the fixed income invested into a strategy that's trying to maximize the after-tax yield using high-quality securities, and it's built with a really solid investment philosophy as its core.
Investing globally does have some advantages in terms of you do get exposure to different yield curves. I will say, looking at the rest of the world and where yields are, yields in the U.S., even though we laugh at how low they are much better than most other places in the world. If you think, you don't ever need to remember too far back. Remember Greece? They were on the brink of collapse. Their yields were 40, 50%. Their yields now are inside U.S. Treasuries. They issued bonds at negative rates last week. So Portugal, Spain, Italy, you look at all the developed worlds, for the most part, they're issuing debt inside of yields in the U.S. So in terms of, yes, you do get a diversification, but in terms of overall yields, unless you're looking at like emerging market debt or something like that, there's really not much to be gained there from a yield perspective. The other thing is, if you're investing internationally, if you're leaving the currency unhedged, that's a whole nother risk that you're bearing. And if you're going to try and hedge that, if you're doing it for an individual client or a smaller account, that's going to cost a lot of money to do. You're probably going to cost you 1-2% to hedge that, and 1-2%, that's going to eat up any benefit from trying to invest internationally.
Yeah, and if you're looking for those strategies, what DFA is doing on their global funds is very impressive, because they are hedged with their exposure, and they're managing it, and then, so even though rates are negative in most of Europe, anything lower than 10 years, and even if you go out further, I think the whole German curve might be negative now.
It's pretty close.
But they're going out there, and because of the hedging, they're picking up currency premiums, which makes it reasonable for them to go actually and purchase those, because they're making money on the differential between where U.S. cash rates are and the euro cash rates are. So that's a good place to go if you do have a policy that requires you to have global bonds as an investment choice.
Well, I really wasn't looking for it, I was just reading the investment manual, and it explained something that I didn't understand.
Yeah.
It said, because of this, we suggest that clients allocate 45%.
Yeah. I mean, there's pluses and minuses to both approaches.
Some people, people might be worried about government debt, U.S. government debt, right? And so they want to diversify the issuer on that regard. Close it out.
Thank you.
Yeah, thank you guys so much for your time.